97%. That's how much oil traffic through the Strait of Hormuz reportedly dropped in just 10 days. That's roughly 17 million barrels per day, about 20% of global oil supply. And right now, most analysts are saying the same thing. This is bad for crypto. Oil crisis, higher inflation, bad for crypto. But that conclusion might be completely wrong. Because while everyone is watching burning tankers and geopolitical headlines, this crisis just exposed something far bigger. A structural weakness in the global financial system, one that XRP was literally designed to solve. And almost nobody is connecting those dots yet. Stay with me, because once you see the connection, you'll never look at this asset the same way again. Today's video isn't about panic. It's about what the oil crisis just revealed about the architecture of global money. No hype, no price predictions, just the logic. Let's break it down. Most people watching this crisis are asking the wrong question. They're asking, how high will oil go? How bad will inflation get? Will the Fed cut rates? Those questions matter, but they're surface-level questions. The deeper question is this. What does this event reveal about how the global system actually works? Because once you understand that, the XRP thesis starts looking very different. The global economy runs on two flows, energy flow and money flow. Oil moves the physical economy. The financial system moves value. But here's the uncomfortable truth. Both systems share the same structural weakness. They depend on choke points. The Strait of Hormuz is one of the biggest. At its narrowest point, it's about 24 miles wide, with shipping lanes only a few miles across. Through that narrow passage flows roughly 1/5 of the world's oil supply. One choke point, one disruption. And suddenly the entire global system feels the shock. Now keep that image in your mind, because the financial system has its own version of the Strait of Hormuz. Today, when money moves internationally, it rarely moves directly. Instead, it travels through a network of correspondent banks. This system is built on something called Nostro-Vostro accounts. These are liquidity accounts that banks hold in foreign currencies so payments can settle. Globally, there is about $27 trillion locked inside these accounts. $27 trillion sitting idle, just so international payments can function. And when you send money internationally today, it often hops through multiple banks, taking days to settle and costing several % in fees. That's the current architecture of global finance: slow, expensive, and heavily dependent on intermediaries. Now, here's the key question. What happens if you remove those choke points? This is the exact problem Ripple has been trying to solve for over a decade. Instead of routing value through multiple banks, XRP allows value to settle directly, in seconds, across borders, using a digital bridge asset. The process is simple. A bank converts local currency into XRP. XRP moves across the ledger. The receiving institution converts it into the destination currency. Settlement time? About 3 seconds. No multi-day delays. No pre-funded accounts across the globe, which means the $27 trillion sitting idle today wouldn't need to exist. That's the efficiency argument behind XRP. And events like the Strait of Hormuz crisis highlight why systems built around choke points are fragile. Quick question for you. Did you already know that $27 trillion sits idle in the banking system just to move money internationally? Comment yes or no below. Now let's come back to the oil crisis itself.
Over the past days, we've seen escalating tensions in the region. Reports of drone strikes on energy infrastructure,
naval activity near shipping routes, insurance risks rising for oil tankers. As a result, global markets suddenly became aware of how fragile energy supply routes can be. And when supply chains break, the consequences ripple everywhere. Energy prices move, inflation expectations change, central banks get trapped between conflicting signals, which is exactly where the Federal Reserve finds itself right now. The Federal Reserve is about to face a difficult choice. Recent inflation data has been cooling, but energy prices are rising again due to geopolitical disruption. That creates a policy dilemma. Cut rates too early, and inflation could surge again. Hold rates too long, and economic growth weakens. Markets hate uncertainty. But uncertainty also pushes institutions to rethink infrastructure, especially financial infrastructure. And that's where assets with real utility start getting attention. Let's look at the scale of the opportunity. The global cross-border payments market moves roughly $150 trillion every year. Foreign exchange markets process about $7.5 trillion every day. And again, around $27 trillion sits idle in pre-funded accounts. Now consider the supply side. XRP has a fixed maximum supply of 100 billion tokens. Circulating supply today is roughly 55 to 57 billion. But much of that supply is locked in long-term holdings, institutional custody, or escrow mechanisms, which means the liquid market supply is smaller than many people assume. And here's the interesting part. When XRP is used as a bridge currency, price affects efficiency. Higher price means fewer tokens are needed to move the same amount of value. Less market impact, less volatility, more scalability. In other words, as institutional usage grows, higher valuations actually make the system function better. While retail investors focus on headlines, institutions focus on infrastructure. Over the last few years, we've seen several developments around Ripple's ecosystem. Partnerships with financial institutions, payment corridors across Asia and the Middle East, institutional infrastructure expansion, and interest in regulated investment products linked to digital assets continues to grow. Whether XRP ultimately captures a meaningful share of the cross-border payments market remains to be seen. But the direction of travel is clear. Financial infrastructure is evolving. The next 12 to 24 months could bring several catalysts for the broader digital asset ecosystem. Regulatory frameworks continue to evolve, institutional adoption of blockchain settlement systems is increasing, and geopolitical disruptions are forcing governments and financial institutions to rethink resilience. Every crisis tends to accelerate technological shifts, and infrastructure transitions often happen quietly, until suddenly they're everywhere. The Strait of Hormuz crisis didn't create the case for XRP, but it did highlight something important. Systems built around choke points are fragile, whether we're talking about oil pipelines or financial settlement networks. The next generation of infrastructure is likely to focus on speed, resilience, and decentralization. And XRP was designed with exactly those goals in mind. This isn't about hype. It's about understanding how global systems evolve over time and recognizing the signals when those shifts begin. If you made it this far, comment "Signal" below. I'm curious how many people actually watch these deep dives to the end. And if you enjoy calm, data-driven analysis without the hype, subscribe. Because the next few years in global finance are going to be very interesting. And we'll be here breaking it down. See you in the next one.